The Mortgage Minute today being brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call, 800-306-1990. Let's take a look at the markets today. The S&P 500 up 31. 10-year Treasury up 5 basis points. Mortgage-backed securities, they're down 8 basis points. Now, the 10-year Treasury, that's the yield, the interest on that is up. And on the mortgage-backed securities, you're seeing that the bond itself is down, as I speak right now, 9 basis points, which means interest rates are up. But let's get to what legitimately is going on in interest rates, because I did watch this morning, and Freddie Mac came out with their mortgage market survey for today, and they said that interest rates dropped a little bit this week. You know better than that. But 5.1% is the number they came up with. Last year, same week, 2.98%. But again, is it legitimate? Did the rates are they really at 5.1? Did they really drop this week? Well, I'm going to tell you.
It is what it is.
OBMMI provides the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual locked rates with consumers across 35% of all mortgage transactions nationwide. And they came out with their report this morning, which is basically yesterday's data, that loans locked at 5.317. 5.317 is where they've locked at. So are the rates down or are the rates up? Yeah, they're actually up a bit. And as I mentioned, when we look at this from OBMMI, they're giving us exactly what loans locked at yesterday. So no matter what that's the average. Now, there could be some higher, some lower, but no matter what you're hearing on the news, on commercials, on the radio, wherever, except for here, that's the exact number of what they're doing. Why is that happening? Well, we got Q1 GDP showed that growth was down 1.4%, which was much lower than a 1% increase. Want to see how they spin this one. This comes after a 6.9% print in Q4, which was mostly due to inventory build. The decline in GDP for Q1 is another sign of potential recession. We'll get 2 more revisions to this figure before getting the final figure in June. An old textbook definition of a recession is 2 consecutive quarters of GDP, which will not be confirmed until September because of the look back and 3 revisions. Initial jobless claims measures individuals filing for unemployment benefits for the very first time, decreased 5,000 to 180,000. Continuing claims, which are those continued to receive benefits after their initial claim, decreased 1,000 to 1.41 million. This is the lowest number of continuing claims since February 1970. Unemployment claims are extremely low and the labor market remains tight. Remember, a recession always follows an uptick of the unemployment number. So last month we came out, or earlier this month, we came out and reported 3.6. If we were to see a 3.7 or 3.8, that's the indicator that usually within about 160 days, we will be in a recession. That's just historic numbers. We don't guarantee things on Ron Siegel Radio. Death and taxes, I guess we can guarantee that those are going to continue. And here in California, they're going to the taxes part will continue to go up. That's the Mortgage Minute, brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call.